Basics of economy. National income. National income is the total value of a country's final output of all new goods and services produced in one year. There are practical difficulties in estimating the national income as per this concept. Hence we use the Pigouvian definition. C. Pigou has in his definition of national income included that income which can be measured in terms of money. In the words of Pigou, national income is that part of objective income of the community including the income derived from abroad which can be measured in monetary terms. National income concepts. Gross domestic product at market prices. GDP is the market value of all final goods and services produced within a domestic territory of a country measured in a year. All production done by the national residents or the non-residents in a country gets included, regardless of whether that production is owned by a local company or a foreign entity. Everything is valued at market prices. GDP MP equal to C plus I plus G plus X minus M. GDP at factor cost. GDP at factor cost is gross domestic product at market prices, less net product taxes. Market prices are the prices as paid by the consumers. Market prices also include product taxes and subsides. The term factor cost refers to the prices of products as received by the producers. Thus, factor cost is equal to market prices minus net indirect taxes. GDP at factor cost measures money value of output produced by the firms within the domestic boundaries of a country in a year. GDP factor cost equal to GDP market price minus net indirect taxes. Net domestic product at market prices. This measure allows policy makers to estimate how much the country has to spend just to maintain their current GDP. If the country is not able to replace the capital stock lost through depreciation, then GDP will fall. NDP market prices equals GDP market prices minus depreciation. NDP at factor cost. NDP at factor cost is the income earned by the factors in the form of wages, profits, rent, interest, etc. within the domestic territory of a country. NDP factor cost equal to NDP market price minus net product taxes.
Gross national product at market prices. GNP market price is the value of all the final goods and services that are produced by the normal residents of India and is measured at the market prices in a year. GNP refers to all the economic output produced by a nation's normal residents, whether they are located within the national boundary or abroad. Everything is valued at the market prices. GNP market price is equal to GDP market price plus NFIA. GNP at factor cost. GNP at factor cost measures value of output received by the factors of production belonging to a country in a year. GNP factor cost equal to GNP market price minus net product taxes. Net national product at market prices. This is a measure of how much a country can consume in a given period of time. NNP measures output regardless of where that production has taken place, in domestic territory or abroad. NNP market price equal to GNP market price minus depreciation. NNP market price equal to NDP market price plus NFIA. NNP at factor cost. Net national product at factor cost is the sum of income earned by all factors in the production in the form of wages, profits, rent and interest, etc. belonging to a country during a year. It is the national product and is not bound by production in the national boundaries. It is the net domestic factor income added with the net factor income from abroad. NI is equal to NNP market price minus net product taxes minus net production taxes. GVA market price minus net product taxes. GVA at factor cost. GVA at basic prices minus net production taxes. 3 measurements of national income. Value-added method, or the product method. Income method. Expenditure method. Value-added method, or the product method. The value-added or production method. is used by economists to calculate GDP at market prices, which is the total values of outputs produced at different stages of production. It needs to be mentioned that caution should be taken to take final goods and not intermediate goods, as it will result in double counting. Some of the goods and services included in production are goods and services actually sold in the market, goods and services not sold but supplied free of cost, second-hand items and purchase and sale of the same. Sale and purchase of second cars, for example, are not a part of GDP calculation as no new production takes place in the economy. Production due to unwarranted illegal activities. Non-economic goods or natural goods such as air and water. Transfer payments such as scholarships, pensions etc. are excluded as there is income received, but no good or service is produced in return. Imputed rental for owner-occupied housing is also excluded. Income method. This method emphasizes on aggregating the payments made by firms to households, called factor payments. It is defined as total income earned by citizens and businesses of a country. There are 4 types of factors of production and 4 types of factor incomes accordingly. Land, labor, capital and entrepreneur or organization as factors of production and rent, wages, interest and profit as factor incomes correspondingly. GDP equals wages plus interest income plus rental income plus profit plus indirect taxes subsidies plus depreciation. The term profit can be further subdivided into profit tax, dividend to all those shareholders and retained. Such an approach is adopted in India to calculate the contribution of services sector to the economy. Any income corresponding to which there is no flow of goods and services or value added it should not be included in calculation by income method. Expenditure method. The expenditure method measures the final expenditure on GDP. Amount of expenditure refers to all spending on currently produced final goods and services only in an economy. In an economy there are 3 main agencies which buy goods and services. These are households, firms and the government. Consumption. Personal consumption made by households, the payment of which is paid by households directly to the firms which produce the goods and services desired by the households. Investment expenditure. Investment is an addition to capital stock of an economy in a given time period. This includes investments by firms as well as government sectors. Government expenditure. This category includes the value of goods and service purchased by government. Government expenditure on pension schemes, scholarships, unemployment allowances etc. are not included in this as all of them come under transfer payments. Net exports. Expenditure on foreign-made products, imports, are expenditure that escapes the system, and must be subtracted from total expenditures. In turn, goods produced by which are demanded by foreign economies involve expenditure by other economies on our production, exports, and are included in total expenditure. GDP is equal to C plus I plus G plus X minus IMC is equal to consumption